So we're going to, I'm going to be talking about goodwill and the sale of business from a legal point of view, and then Mariana and Natalie will be talking about it from an accounting and valuation point of view. So I guess a good place to start is so what and who cares. As you can see from the overhead, goodwill has an impact on all sorts of things, foreign resident entities in CGT, buying shares in a company that may be land rich. That in fact was what, there were two High Court cases that I'll be referring to. One was in 1998 called the Murray case, which was to do with the sale of a taxi licence. And another one was just 2 years ago, the Placer case, which was to do with land tax in Western Australia. So when we're talking about land-rich companies and buying shares in land-rich companies, it certainly has relevance there. Purchase price allocation issues. The whole thing about these two cases, particularly the second case, is that the concept of goodwill has been fine-tuned, and the tax office has not yet caught up with this High Court case that was 2 years ago. What is goodwill? So accountants say, and lawyers used to say, because Placer changed the concept, it's the excess that a purchaser is willing to pay for a business over the fair value of the identifiable assets acquired. It's intangible property. And lawyers say, well, it's the legal right to conduct a business in substantially the same manner and by substantially the same means that have attracted custom to it in the past. And that's what Placer said in this case 2 years ago. It concentrated on this concept of attracting custom. It went back to cases in 1905 where they were talking about getting people in the door and that sort of concept. And of course now we get purchase orders and emails and social media and online advertising, but the concept is the same, and we talk about attracting custom. Goodwill has no existence independently of the conduct of the business. You can't carve it up and say, well, I've sold that trademark and that, you know, but so many hundreds of thousands or millions of dollars of that sale price can be allocated to goodwill. It just doesn't work that way. And goodwill can be protected. We all know that. Restraints of trade, restraints of competition, protecting confidential information. It's all part and parcel of this area. Sources include sources of goodwill. We're not talking about elements of goodwill. We're talking about where does it come from. It can come from tangible property, for example, the second bullet point, site goodwill, where, you know, where the local news agent is located. It can come from intangible assets, for example, trademarks and patents. And there are other sources. It can come from sources that are not assets. It can come from enforceable restraints of trade, statutory monopolies, personality of the business owner. That's one asset, or key, you know, the rainmaker in the business. And service delivery, price, habit. You know, I've been using Colgate toothpaste for I don't know how many years. My dentist says that I should be using Sensodyne. I just can't keep the habit. I'm just stuck to Colgate. Sources can change over time, and I've given you an example here with a museum. So this museum, this National Museum, spends money on advertising and promotion. It's got specific items that it picks and chooses for its exhibits. It's located near a CBD. It looks good outside and inside. It's nice to be in. So those are all sources of goodwill for that museum. And they decide, look, you know, we're missing out on the 18 to 35 age group here, even though we're near schools, but we're just not getting a huge chunk of the demographic. So let's advertise online. So they start spending money advertising online, revenues go up, and that's a new source of goodwill for the museum. The money is spent on marketing social media. And goodwill can be sourced from non-legal assets. So I mentioned the personality of people there, the owner, the employees. The goodwill can continue. This is something that I have a bit of an issue with, and I'm not quite sure why, but it can continue to exist, notwithstanding the sources may change over time. Habit may continue to draw custom even though the former owner is no longer there. Yeah, I guess so. That was in the Murray case. I guess that can happen. And but as I say, Murray was about a taxi license. Place was about buying shares in a land-rich company, and it's very dangerous as a lawyer or anyone to grab a sentence or a paragraph in any of these cases and start applying it to other arrangements, facts and circumstances. All of them are very specific to the facts of the case. When is goodwill acquired or created? It can be acquired. It's acquired on the date of the contract. This is your first lesson for accountants but for business owners, generally speaking, unless the contract says otherwise, you don't acquire goodwill when you pay for the business. You acquire it on the date of the contract, just like you acquire for CGT purposes a block of land when you sign the contract. It's created, on the other hand, when the work that results in its creation started. So in our museum example, when they started the social media campaign, that's when the goodwill began to be created as far as it was sourced from social media. The Murray case, 1998 in fact, and Murray is M-U-R-R-Y, some sort of name. So in that case, they had a number of taxi licenses, and they sold one. They sold it for 3 or 4 times for what they bought the license for. And they were sought to get the 50% CGT exemption and said for goodwill. And they said, well, the difference from purchase price and the sale price years later is goodwill. The High Court said, well, no, the taxi license wasn't the source of goodwill. It doesn't attract custom. Just because you've got a taxi license doesn't mean you're going to make any money at all. All it did was authorise the lawful conduct of a taxi business. But then, again, exception. Take Domino's Pizza out in Cunnamulla, a big, massive town of maybe 30,000 people in Western Queensland. If you've got the only Domino Pizza franchise out there, then the licence for pizzas is a source of custom, because nobody can get pizzas anywhere else. In the Murray case, they said, well, look, the source of custom, the goodwill, didn't come from the taxi licence, as I've said. It came from the get-up of the taxi, the money spent on advertising, the driver. He sort of knew the drivers, that they had been there for a number of years. They knew the best locations to go to get passengers, and that's where goodwill came from. One of the key things that this case said is that goodwill does not include everything that adds value to the business. Some assets have the power to draw custom, for example, trademark. And as I've said, if you're selling a trademark, you're not selling goodwill unless the trademark is with the trademark comes the business itself, then you are selling the goodwill. But if you're just selling the trademark, you're not selling goodwill, because goodwill is attached to a business. And I guess what happens? Where does the goodwill go? If there's everyone knows that, you know, Kodak, Coca-Cola, whatever, you sell the trademark. If you're not selling goodwill with the trademark, and the profits go into the ground like a dart, so where does the goodwill go? It disappears, I suppose. And of course, this is why people often have double branding, you know, Acme Smith, and then it eventually becomes Smith over time. But the point about it is, as I mentioned before, that there's a limitation on how much you can pull out of a comment made in these cases and then say, well, therefore, and you get a question that you can't answer. Cases are fact-specific and legislation specific. A lot of the cases talk about the nature of goodwill. Some of them talk about the value of goodwill. Some of them talk about the sources of goodwill. And then in the last bullet point, you've got to consider what legislation were the judges thinking about. And it's very dangerous to extrapolate from one case to another. So you're really looking, what we're really doing this morning is looking at the general concepts which can safely apply across the board. So as I've said, the legal view of goodwill is that it includes sources to generate earnings by attracting custom that doesn't extend to every possible advantage. And one of the issues in relation to that I just thought I'd mention, which I find difficult to understand, is that the High Court in Murray said, oh, look, you know, a business can operate and it can have a regular clientele and have a great reputation for reliability of service and have skilled employees, and it's got this, pardon me, it's got this goodwill because it generates above average earnings. No kidding. And you're thinking, what? So if you take that paragraph out of Murray, which Placer talked about, you've only got goodwill if you're getting above average earnings. Really? As I say down here, Placer did not explain the comment. It quoted the paragraph, but didn't explain the comment. Maybe it's explained by reference to the fact that not all things which generate value or earnings comprise goodwill, but who knows? That's just a question I have about that comment, and I've never heard it said or explained. I've never heard people rely on it. I've never heard it explained. So let's just leave it in 1998 and move on. Valuation of goodwill. So we might be splitting hairs in relation to the lawyers and the accountants. They will be splitting hairs in relation to a profitable business. The concept of legal goodwill and accounting goodwill are going to be the same very frequently in that case. But in here we go. I'm pressing the right button here. Is this working?
Oh, you've just moved on now.
Yeah.
That's a new slide.
Trading at a loss. Okay. In a profitable business, the value of goodwill for legal and accounting purposes may well be the same. But if you're trading at a loss, you can still have legal goodwill. So you've got a business trading at a loss, but it's still got goodwill. It's still advertising. It's still getting in clients. There's a source of goodwill. The owner's still there. They still say, how are you, Joe? You know, how are things going? They like dealing with Joe. A lot of people still like dealing with Joe, or key employees, but it's trading at a loss for other reasons. So from a legal point of view, just because the business is failing doesn't mean that goodwill is worth zero. Now, I'm not a valuer, I'm not an accountant, but I do know that people, the valuers and accountants that I speak to, often say to me, oh, you know, you just get the tangible asset value, sell the equipment, sell the land, sell the bits and pieces, and that's what the business is worth. But from a legal point of view, that's not necessarily the case, which means, of course, the other assets must be worth less, but maybe from an accounting point of view, that's not the case. They're sold for what they get. So there's a tension there, and I don't know whether Diana or Natalie can explain that, but legally there can be goodwill in a failing business. Oh, that's great. Okay, so the crux of these discussions is this concept of the bottom-up approach or the top-down approach. So the bottom-up approach is where you deduct from the present value. This is what most people think of. This is what I have been up to recently thinking of. You deduct from the present value of predicted earnings, i.e. the going concern valuation, what people are prepared to pay for. You deduct from that the fair value of the identifiable net assets, and the balance is goodwill. And that's what Barrick did in Placer, and it didn't work. The Placer shares were $12 billion. The land was worth $6 billion. And Barrick said, well, the difference is goodwill. Goodwill is $6 billion. And High Court said, no, it's not. And because the goodwill was pretty much written off to a couple of million or something, the High Court then said, well, your land must be worth $12 billion. The goodwill's worth zero. Your land must be worth 12. And so you're over the 60% threshold, and there's going to be land tax of $53 million. Thanks for coming. So, yeah, that's what happened in Placer. So the High Court said you don't do the bottom-up approach by taking the sale price, the going concern value, deducting all the assets, and then the rest is goodwill. you do the top-down approach. You start with the total value of all the assets and deduct the non-land assets, including goodwill, to get the residual value of the land. In other words, you don't deduct the land from the going concern value, you deduct the goodwill and everything else to get the value of the land. This is a land tax case in Western Australia. Okay. Unless alleged sources of goodwill can attract custom, they do not contribute to the generation of legal goodwill, although they may contribute to the going concern value. Said the going concern value reflects the ability of a business to generate income without interruption, even where there has been a change of ownership. Goodwill reflects the value derived from attracting custom. So goodwill is a subset of going concern. Where did Placer go wrong? This is what he said. This is what Barrett said about, I've got goodwill, I've got $6 billion worth of goodwill. The employees at Placer have a proven capacity to develop and expand the business. Placer was one of the largest gold mining companies in the world, as was the purchaser of the shares, and they then combined to be the biggest gold mining company in the world. So he's saying, look, I've got $6 billion worth of goodwill here. One of the sources is the employees, because they've got a proven capacity to develop and expand the business. But the evidence was that they're going to sack most of the Placer employees after the merger. So the High Court said, well, that's highly implausible, so I'm going to discount that. And then he said, well, look, we've got personnel and they've got a technical capacity to develop innovative mining techniques. You know, we're right up there, we're the best of the best. The Stamp Duty Act, the Western Australian Stamp Act said, well, you can't, in doing this valuation, you don't take into account the technical capacity to develop innovative mining techniques. So that was out of the picture. And they said, well, okay, how about this? We've got experienced project group and mine managers. They are really good. And the evidence was that, well, any other mining company could have easily done what you people are doing. So there's no unique expertise and ability with your people. So I'm not going to take that as being any contribution or source to goodwill. And finally, they said, well, look, it's the size and the structures and the systems. We've got economies of scale. That's a source of goodwill. The High Court said, well, what is goodwill? How do you get more people through the doors because of the fact that there's, you've got the biggest company in the world? Why does that of itself bring people in? Why does that attract customers? It doesn't. Economies of scale make the business more profitable, but they don't attract custom. So, what are our conclusions on this? Okay, everyone needs to be aware of this and have regard to the statutory context. Goodwill is an active asset for the small business CGT concessions. Keep purchase price allocation worksheets so that this concept of goodwill is uppermost rather than a leftover. Think, well, okay, and how you attract, how do you, and this is now from Mariana and Natalie, but my question is, how do you value these various sources that attract custom? If that's what goodwill is, and it's not just a residual, let's work from the bottom up as opposed to the top down, how do you value that? And a very practical thing to do in running businesses is to update the tangible and intangible asset values before the sale of the business or before you do anything that's going to deal with goodwill, because that's going to help reduce the value of goodwill and it's less likely to be challenged. But I do believe once the ATO gets the head around this, there will be new rulings coming out, directives and guidelines. And of course, as we know, rulings aren't the law. It's just the way the tax office sees things at a particular time. And does that mean that the courts are going to chase down people who've complied with tax rulings at the very time, even though there's been cases Where the tax rulings become out of date. I suppose that's a key question as well.
So the things I want to discuss is, and I've got 10 minutes, so I'm not going to discuss in depth, but I think I can lead you through to how we would think about it. Sale of business versus shares is your first point of call. And I'm going to delve into a little bit more on the sale of business, areas of risk, and the tax perspective. So sale of business, I guess, is when you're thinking goodwill, you're thinking buyer, purchaser, and you're thinking, okay, I'm going to sell either the shares or the business. Now, if I sell the shares, I sell the shares. Market value, arm's length, all good. Goodwill may come into it if I tax consolidate. I'm the purchaser and I tax consolidate. I might need to understand what the goodwill is when I do an ACA count. I'm not going to go into that, but that's just something to be aware of. So I'm going to go and look into the fact, okay, I've sold my business. So I need to think about what assets have I got in my business that I've sold? And why am I even bothering to break down my assets into tangible, intangible, and so on? Because I want to work out whether one is how I'm going to split, if I'm selling the business, how I'm going to split the consideration against all the assets. And am I going to be able to reduce my tax by some of these assets being entitled to some of the CGT concessions, whether it's the normal 50 general % discount or the small business concessions, depending on the size of the business. So I need to look at it from that aspect as your advisor. So the first thing to do is we identify all the tangible and intangible assets. And there is a valuation guide, which actually the ATO produces. And in that valuation guide, it splits down what assets are. So what are tangible and what are intangible. And in that, it says you split your assets into the following categories: cash, cash equivalent, actively traded, inventory, other tangible assets, which is all, yeah, we all know that. And then it says identifiable intangible assets. So let's look at that in a minute. And then you assign your market value to each of those accordingly. So we said we've got intangible. So the ATO guideline determining the market value for tax purposes, so it looks at more from valuation. Also in that guideline, it breaks down what intangible assets can be split into. Now, in that guideline, it also refers to a particular ruling, which we'll be discussing, and that gives us more information. So that's kind of what the ATO is thinking of how we approach intangible assets. So intangible assets, we look at AASB 138. I'm not an auditor. Auditors in the room can tell me that. But it basically, if you have contracts. So if there's contracts of value, that has a value in itself. So they may be an identifiable intangible. Then you look at intellectual property, which some of you are talking about here. Owner of license of a patent, registered design, copyright. It's not a CGT asset, hence it sits in capital allowance section. So from a tax perspective, it doesn't get the discount. So hence why we might want to portion more to goodwill than an intangible. So goodwill is not defined in the Act. It is in the Act as a capital gain, but it's not defined of what is the goodwill. How do you actually measure it? Hence why, and hence why Murray's case and the ATO ruling assist with that. So as you know, it's the purchase price that's greater than the market value of your tangible and intangible assets equal to goodwill, which is residual, where Murray case supports that. No mention of the Placer case. So maybe the ATO hasn't caught up with it. It is a stamp duty case. So if we're talking about tax issues, obviously the guidelines are there to help us. And the ATO would approach it from their rulings and guidelines. Now, as I say, rulings aren't, you know, they're not binding or anything, but certainly why would the ATO go against what they've ruled? And why would they take you to the court if you've done it exactly the way that they want you to do it or have thought through it? Three broad areas of risk. when you're doing this is, have you got the total transaction value? Is it accurate? You're dealing at arm's length, so assume that it is what a willing buyer would pay. Have all the assets been identified, recognised? So that's a good question, and that is what the values would do. And then you allocate, have you allocated correctly to the underlying assets? Keeping those things in mind. Tax perspective, I guess, biggest thing is you think about is there's always a conflict between the buyer and seller, how they want to allocate the assets. Would you agree with that? And in a lot of contracts, we don't actually split down the assets and the values. Would you agree with that? And why is that? Well, I think it's a lot of cases is because the buyer and seller may want to allocate it differently. So they have their own valuations done and be able to support how they've allocated it. Now, obviously, ideally, the contract will have it all nicely split out. And if there's no contentious issues there, like pre-CGT Goodwill, then you could split it out in the agreement. So as I was saying, the purchaser wants to maximise consideration for trading stock and depreciation because they can get a deduction, claim it as they go along. And the vendor would aim to maximise consideration where they have pre-CGT assets, including goodwill, and CGT assets applying to concessions. So they want a bigger consideration. So there is a bit of a tug of war with which way should we go. And not in all cases, because in some businesses, maybe the vendor doesn't have pre-CGT goodwill. And I think, and you know, that's the source of our discussion here is the goodwill and where is it relevant and why does it come into the tax sphere, if you like. So the ruling sets out the ATO's views on the treatment of goodwill. Remember that the ATO guidelines that I mentioned that are available for anyone on valuation of goodwill for tax purposes mention this ruling when you look down the list of goodwill. So purchase goodwill, Lee was mentioning the date you enter into contract, where you purchase the goodwill. Internally generated goodwill, that's the bigger one. You know, a business might be pre-CGT. How did that happen? Could be they have ran the business initially, they run a business without forming a company, they rolled over into a company later on. Business still has that pre-CGT element, it kept the pre-CGT element. The shares might be post, but so long as there's no change in ownership, potentially the goodwill can still be pre-CGT. That's an important point because the goodwill is a single asset. It's not split between pre and post. If it's pre, it still stays pre, so long as you've continued and you've got the same business. It can't be a capital improvement. So say, for example, the company buys another business with goodwill. Now, potentially, you could have two businesses quite separate from each other, but it could be that they meld together and the goodwill of the new business becomes the goodwill of the old business. So it still keeps its pre-CGT status. You try saying that in the morning. And goodwill can't be disposed of separately. I can't just go and sell it. It has to come out of something, the business itself. So why is it important? The pre-CGT goodwill is important because there's no tax on it from a seller's perspective. Post-CGT, if you have goodwill there, you get the 50% discount and potentially you get the small business concession depending on what you're actually doing. And that's a bigger piece.
So today I'll begin by exploring the theory behind measuring goodwill for valuation purposes, and then I'll introduce the more practical process to understanding the value of goodwill in your business or your client's business, and how this may relate to a potential sale of business. So before jumping into the presentation, I'll just briefly explain a little bit about the work that my team and I do here at HLB. So we assist our clients in a range of business transactions as well as general advisory. Our experience and some of our main service offerings relate to valuations, mergers and acquisitions. In terms of mergers and acquisitions, we're able to assist our clients who are looking to exit their business, achieve the maximum value possible, or on the other hand, we can assist with businesses who are looking to acquire another business. Our advice ranges from the preliminary research into potential buyers and sellers, all the way through to negotiating the share purchase agreement and finalising the transaction. So in terms of business valuations, there are a number of reasons why a business may want to know their value, which are on the screen there. So one of the key reasons might be that you want to know the value of your business in relation to tax restructuring, such as understanding the tax consequences of a restructure or allocating values as part of a tax consolidation. To assist in introducing employee share options or share schemes, which may be used where you want to bring in employees into the business and incentivize them. Providing an independent opinion for an expert report or a dispute resolution, or just as part of the general sale process and estate planning process. So in relation to the point on the tax restructuring, one cause of this restructure may be where a business has recently made an acquisition of another business and require a valuation in order to set the cost base of the assets acquired. This would involve a purchase price allocation, which also involves the official recognition of goodwill, so I'll go into that in more detail now. As Lee discussed earlier, for accounting purposes, goodwill is essentially defined as the value an acquirer is willing to pay in excess of the net identifiable assets of the business. If an acquirer is willing to pay in excess of the identifiable net assets, there must be something of value in that business that would cause an acquirer to pay extra. The accounting standard AASB 3 on business combinations requires that an acquirer recognises the assets, liabilities, and contingent liabilities assumed through purchase price allocation. And so this process is essentially allocating or apportioning the purchase price of the transaction over the fair value of the tangible and intangible assets acquired, and any remaining amount is classified as goodwill. So in relation to the two methods of valuing goodwill, which Lee mentioned earlier, this uses the bottom-up approach. From my experience in valuing businesses, the bottom-up approach is used in valuing goodwill. So this is what I'll explain in a little further detail. So a purchase price allocation and the valuation of goodwill applying the bottom-up approach involves the 4 stages, which are shown on the screen. Following an acquisition, the value of the business is determined as the fair value of the total consideration paid in the acquisition. This essentially represents the present value of the future cash flows, as this is what an acquirer is paying for the business. Next, the net tangible assets must be assessed at market value. So there may be some differences in the market value and book value of some assets. For example, the market value of inventory may exceed its book value, since in the balance sheet inventory is measured at cost, whereas in reality it will likely be able to be sold for more than that. So there'll be an uplift in value when recognising inventory at market value. Likewise, property, plant and equipment is also measured at cost. So if it can be sold at a higher amount, there would be an uplift in value there. And contingent liabilities, which may have not been previously recognised on the balance sheet, is recognised at market value. So once the net tangible assets are identified, we then consider the identifiable intangible assets. So Mariana touched a bit on what classifies as an intangible asset, but essentially it's just those assets in the business which provide a significant contribution to cash flows and which can be separately identifiable and meet all the other aspects of an asset. And so this may include some items such as the brand name, software or customer relationships. It's at this point that these internally generated intangible assets can be recognised on the balance sheet for the first time. So goodwill is then calculated as the difference between the business value, that is the purchase consideration, less the net tangible assets and identifiable intangible assets. This amount essentially represents the value that an acquirer places on intangible things in the business, which cannot be separately recognised as an intangible asset on its own, but does hold some value. So a good example I like to use is an assembled workforce. So the purchase price allocation process I've gone through is when goodwill is officially recognised. However, what if you would just like to know what the general value of goodwill is in your business? In order to practically understand the level of goodwill in a business, first of all, you need to have an idea of what the business is worth. So I just want to highlight that what I will talk about is mainly in relation to small to medium-sized businesses, and the level of complexity and approaches would differ for, say, an early stage high-growth startup or a larger company. So broadly, there are three common methods applied when valuing a business, which are the capitalization of earnings or multiples approach, the discounted cash flows methodology, and the net assets approach. So the multiples approach involves establishing what the future maintainable earnings of the business is, and then applying a multiple to calculate the enterprise value. This method is the one that's most commonly applied in practice and most easily understood, and it can be used where the business is profitable and has stable earnings. The discounted cash flow methodology involves forecasting the cash flows of the business over a forecast period, say 5 to 10 years, and then discounting those cash flows back to the present value. This methodology is considered to be quite robust, and it is very specific to the business that's being valued. However, there's also a number of assumptions that goes into that calculation, so care does need to be taken there. This technique does require that the business is profitable as well, and that management prepare reliable forecasts. Finally, the net assets approach, which Lee also mentioned, is commonly applied for businesses with negative earnings and essentially calculates the value of the business as the sum of the market value of the assets less liabilities. So it's important to note that from an accounting perspective, when the net assets approach is used to value a business, it is likely that the goodwill will be nil. Okay, so if a business is generally profitable, a simplified multiples approach can be used as a rough indicator of business value, as shown on the screen. Once you determine the level of future maintainable earnings in the business, you can then apply a multiple, which for a small to medium-sized business, a rough guide would be a multiple of say 3 to 4.5 times. And then you can calculate the enterprise value of the business. Once you have a rough idea of what the enterprise value is, you can then calculate the level of intangible assets in the business, which would inherently include the goodwill. So this is done by subtracting the net tangible assets of the business from the enterprise value. However, it's important to note that the value of these net tangible assets must be measured at market value. So once the level of intangible assets is known in the business, you may wish to consider what this amount relates to. So it may relate to some of those other intangible assets, such as trademarks. However, it's important to note, as I mentioned, that these internally generated intangible assets cannot be recognised unless a business transaction has occurred. Also, it's common in practice for small to medium-sized businesses for no intangible assets to be identified, apart from goodwill, just given the strict criteria it takes to identify an intangible asset. So the valuation methodology that I just went through can be used as a benchmark and remeasured at later periods in time, which could indicate whether the intangible assets or goodwill in the business is increasing or decreasing over time, assuming that the level of net assets is roughly consistent over that time. So as a business owner or advisor, it's important to consider what factors will increase the business value, either as a way to increase the profitability in the business and subsequently the value for the equity holders, or in preparation for a sale transaction to get the maximum value for the sale. So this slide on the screen indicates which factors are likely to influence the business value and may increase the overall goodwill in the business. For example, strong staffing policies or business processes would increase the value of the business. However, these factors cannot be separately identified as intangible assets on their own right, and these sort of aspects would be captured in the value of goodwill of the business. So everyone should now have a general understanding of how to identify goodwill in a business and some techniques to measure over time and perhaps methods to increase the value of the business. If you want to know the value of your business or have any other questions, please let me know.